Alrighty, everyone. Good afternoon and welcome to the fifth seminar in the LaunchPad Bootcamp program, this week focusing on investor relations. So this is the second last in our LaunchPad Bootcamp series and will definitely be one of the most valuable and insightful, touching on some burning points to prepare you for investment. I would love to welcome everyone tuning in today. Welcome to all of the LaunchPad attendees in Zoom. We're delighted to host you as part of our Bootcamp program. I would also like to give a special welcome to those watching the in-conversation of today's program via Slido through a live stream. So before we begin, it's my honor to acknowledge the traditional owners of the land. Whilst we're dispersed across many traditional lands, we are connected virtually. I'm coming to you today from the unceded lands of the Boonwurrung, Boonwurrung, and Wurundjeri Woiwurrung peoples of the Eastern Kulin Nations. I acknowledge the continuous and unbroken custodianship of the land, waters, and culture of this country, and thank the elders past, present, and emerging for allowing us to gather here today. I pay my respects to all Aboriginal and Torres Strait Islander peoples with us here today. So, as I mentioned, today's program is the fifth in a series of 6 meetings that connect you with a network of experienced entrepreneurs, investors, educators, with the tools and insight to grow your business. For the first portion of today's session, we will facilitate a discussion with guest speakers David Linke, Peter Mobbs, and Judy Park, who will dive into the role and importance of investment in the edtech sector. Very excited for this session today. We're very grateful to have you join us and give you your time this afternoon. And one more thing before we move into this conversation, Edugrowth programs like these are only possible through great partnership. Edugrowth is delighted to have the partnership of Amazon Web Services to bring the 2022 LaunchPad Bootcamp program to you. I would like to thank AWS and the team, including Mo and Camille, for their long-standing partnership and collaboration with Edugrowth. To learn more about the benefits of partnering with Amazon Web Services EdStart and to apply to become an AWS EdStart member, we'll post a link in the chat where you can access their webpage. Without further ado, I'm delighted to introduce today's guest, and then we'll promptly move into discussion. So I'll introduce the facilitator, David, and then I'll pass the baton on to him, and he will introduce our other speakers, and we'll just get right into the discussion. So David leads Edugrowth as the managing director, bringing decades of experience leading education, technology, software, and services businesses across Asia Pacific. Thank you for joining us, David.
Thanks, Jonathan. It's a real pleasure to be here today. I'm in a slightly different environment. Those who have seen me for the last couple of years will have known my lounge room really well. I'm actually in a hotel, so technology might fail me. I might knock over this table and the computer might go flying everywhere. So looking forward to this conversation. Peter and Judy and I have all been in conversation for many years. So facilitating this chat will be great. So why don't we ask Peter to join us, who is the managing partner of 5 Sigma, a global edtech focused growth fund. He's invested in edtech for a very long time and actually exited a couple of businesses as well. So thanks for joining us, Peter.
Thanks, David. Good to see you.
And Judy Park is a key player within our ventures, one of the largest edtech venture capital investors in the world. She's focused purely on educational workforce technology, and she leads the firm's contribution to the largest edtech companies across the education spectrum, and hopefully we might get some inside knowledge. Thanks very much for being here, Judy.
Thanks for having me.
Just a reminder to anyone, you can ask us questions as we go. You can just dump them in the chat and they'll end up here, and we'll stop if we have a nice pause. So let's get going. Why don't we begin by tell us a little bit about your investment thesis, Peter. Give us a bit of insight to the things that 5 Sigma invest in. And that's a new name, by the way, isn't it? Right? Like I had a slightly different name in my head, but you've changed the name of the business. Is that right?
That's right. Well, kind of right. So,
okay.
Dave, you and I, as you said, have known each other for a while, but I've been investing off my own balance sheet. We've had a couple of different exits and we've been investing actively, but it's been, me. But as of May this year, we started a fund where we're now managing outside money, and we're focused exclusively on edtech. So very relevant for today's conversation. This is what I really know and love. But when you have a fund, you've got to stand for something and you've got to be focused. So we're not only focused exclusively on edtech, but we're focused on sort of Series C and D round, so later stage than I've been investing personally. And within that, we'll look at anything. So if it's EdTech and it's Series C and D, we'll go globally to any corner of the globe for the best deals. And we'll look at any vertical within EdTech. So, our most recent investment is in a business called Go One that you would know. And that's in the workforce readiness and skills development space. And then prior to that, we invested in a business called Academia, which is more about academics sharing their research. So we'll look at anything, so long as it's EdTech and late stage.
Awesome. All right, we'll come back and unpack that in greater detail. Judy, you want to give us a bit of an insight to OWL and the investment thesis that you take? And then maybe we might jump into some of the ideas that we've got to help EdTech founders on that path. But maybe start with telling us a little bit about OWL and the investment thesis.
Yeah, happy to. So OWL Ventures is the largest venture capital fund that's focused on education technology, defined widely. So whether that's kind of early childhood, K-12, university, workforce training, lifelong learning, et cetera. And we'll also invest in the ways that learning and education intersect with other verticals. So we've done things in edutainment like masterclass, things in fintech with the financial literacy angle, things intersecting with mental health, the creator economy, et cetera. And besides our sector focus, we're pretty flexible in our investment mandate. So we're truly stage agnostic. We've done anything from pre-seed to pre-IPO and also geography agnostic. So we have 75 portfolio companies now across kind of 6 continents today. So really the thesis is to invest in the best education companies across stages, across subsectors, across the world.
So you've given the gambit. We're going to come back and we have to define. Let me just put a little note here. The best education investments. We're going to come back and unpack that at some point because you've given us that as you're going to be able to help us become millionaires as well in this process. So I'm waiting to come and hear about these best investments. But before we jump into that, what I would like to do is open a really broad question for you both. And I'll start with you, Judy, to give me a bit of insight into what are the things you wish you could say to early stage founders before they get to you? What are the things that you see all the time that you see, hey, you get this wrong, understand this and think about this before you start talking to investors?
Yeah, that's a great question. I would say, well, generally what we're looking for at the earliest stages, obviously you don't have that much kind of data or traction or proof points at that point. I think generally what we're looking for in that stage is one, just kind of the market opportunity, right? And just this, given that we do know the landscape pretty well, generally know who the key players are, which problems have a ton of solutions already, which don't, how kind of, new and, massive is the market that the founders are tackling. So I'd say advice there is obviously thinking about, your market size and how you kind of expand that over time, but also really having a good sense of your competitors. We do sometimes talk to, early stage companies who are not aware of their competitors. And I think that, that could definitely use some prep as well. I'd say secondly, we're always thinking about, especially at the early stage, like what is that insight that the founder has had through their kind of discovery process that we've kind of never heard before. That's kind of a new insight that they're bringing to tackling that problem. Definitely important as well. And then finally, just kind of like that team market, company fit, right? And so the founder, how kind of, passionate are they about the problem? Are they the types of people who are really going to be, making this work no matter what? Just kind of have the right kind of members in place in their team to make that work. So, anything you can do there around, kind of proving that and just kind of being able to lay out what you've learned, what you've done, and who you've attracted to your team, I think has always been helpful.
I think that's a really important point, and I took 5 notes from that: traction, understanding market opportunity, competitor analysis, and insider discovery into the solution delivering. And then I've got the team piece, and I want to unpack some of that in a minute. But I might give you the same opportunity, Peter, to give me a bit of an insight into the things that you see that you want to really see from founders, or they're getting right or wrong. You can give us the positive as well, by the way, if you really think there's some awesome thing that you want to share with people too.
So I think Judy answered that one well, that and I'd be looking for broadly the same things. Just to add a couple, probably the most important for me is focus. If there's a business that's doing all these things and they've got all these great ideas, it's just confusing from an investor's perspective. Like, what is your core business? If you just say, I just do one thing and I do it really well, then my ears will prick up and my eyes will light up and I'll be interested straight away. So having focus is probably the number one area. And I know from a founder's perspective, that's actually really, really hard. It's easy to say as an investor, but when you're starting out, you also need revenue. So you'll do a lot of things that maybe you don't want to be doing 5 years from now, but you do it because you know that you've got to keep the lights on. So I'm not knocking a business that doesn't have focus. It's just certainly a lot easier from an investor's perspective if you do have focus. Probably the next one is around understanding how you're different from everybody else, or approaching a problem that's not unique, but approaching that differently. That's really what investors want to see, that you're investing into a business that has sort of long-term defensibility, and that can start by being different to everybody else, approaching things with a different problem or different technology solutions.
Can I just jump in there for a minute, Peter? You use the word which I like, because I want to ask a question off it, which is defensibility, right? When we talk about defensibility in investment or in organizational capacity, right, competitive advantage, defensibility comes to the exit, right? Like you're saying, is this business defendable? Is it going to be able to get through to the end? Which raises the question, I'll ask you the same thing, Judy, as well, which is, when are you thinking of the exit in this conversation with these investors? How early in this process are you thinking about how will I exit?
As soon as I understand the business.
Okay.
I think, well, where could this go?
Yep.
What type of, is this the type of business that could one day list on an exchange? Is it something that could be on the NASDAQ one day, or is it going to be attractive to a trade buyer, or is it going to be of interest to other VCs or perhaps private equity? So as soon as I've got my head around what the business actually does, then I would be starting to think about what are the exit opportunities. And hopefully the founders have also thought about that. They should be thinking about, where could I take this business one day? And you don't need to stress about it. You don't need to invest too much time in it. The most important thing is just to get the business up and running and successful. But you should also think, well, where could I go? So in answer to your question, straight away.
Judy, same thesis?
Yeah, totally agree with that. I think, just also given the size of our funds, we're really looking for companies that we think can kind of IPO and have, $1 billion plus exits, definitely thinking about that right away. But, as investors, we're always thinking about kind of different scenario planning, as well as thinking about that on the upside. And then, if that doesn't happen, and obviously there's a lot of pathways that especially early stage companies can go, to Peter's point, is this one that's going to be attractive to a financial buyer, a strategic buyer, or where does this go from there? And then you're also thinking about just kind of the cash profile of that business at its maturity, and can they sustain themselves over time? Those types of questions from the get-go.
So let me add my own view on this idea of what I see from edtech founders that I think that they get wrong in pitch decks all the time. And I'm going to ask you to add on to it as well. And I'm going to keep referring back to the bullet points that I've just taken from your opening remarks, which is traction, market opportunity, competitor analysis. I also put in a competitor advantage as well, which I think is an extension of that. Insider discovery team, and now I've added focus in there from Peter. One of the things that I wanted to add into there is unattainable total addressable market statistics that I see in early stage edtech founder pitches, which is this idea that there's 6 billion people and I only want to sell to 50% of them. So therefore my business will have a total addressable market of 3 billion. You're both laughing, but you've seen those pitch decks, right? So I want to ask you to give us a bit of an insight as to, and I'm pausing for a second to come up with the right word here, right? I was about to say believability, and then I thought of another word, but I'm going to stay with the believability. How believable do you want to see this founder's pitch in this idea of their total addressable market and what their traction might look like over 2 to 3 years. And at the same time, maybe, Judy, I'll ask you, is how many years of forecast are you wanting to see in this pitch deck?
Yeah, that's a good question. Tackling that second question first, the forecast, I mean, I think we generally probably see, teams giving us kind of 5 years. Some people give us shorter, but we ideally want to see at least 5 years. I do think in an early stage company, we're probably thinking like a 10-year plus exit. So if that's available and if that's a picture that you could paint, I think that would be helpful as well. Like oftentimes we'd have to kind of make our own assumptions around all the way up to 10 years. And that's always helpful if the founders have thought about it that far. In terms of the TAM question, I definitely think reasonable and believable is good in that, like it's kind of like what David mentioned. I think sometimes we get like ed tech, industry is this big. And so that's our TAM. But, generally, I think obviously thinking about what, users you're targeting, what geography you're targeting, and the price point you're putting on that, that's oftentimes how we would think about the TAM, at least in the near term, more kind of bottoms up instead of kind of top down in that manner. And then I do like to see the expansion TAM as well, and I know Peter has, emphasized focus, and I definitely think that's important, but to the extent that we could paint the picture of over 10 years plus, we can unlock more markets or increase price or something like that to get to even bigger markets. I like to kind of see that logic chain as well.
The same question to you, Peter. What sort of time frame are you looking for in forecast, and what makes total addressable market believable?
Around about 5 years in terms of a forecast.
Yep.
If it's 3 years, it's okay. 5 years is better. Beyond that, it's a bit of a thumb suck. In terms of the TAM, it's just a hard thing to do. Like it's easy to throw stones, but when you're the founder coming up with the deck, you've got to come up with a number. You've got to present, this is how big it could be. This is the addressable market. And it's not an easy thing to estimate. You're using imperfect data. And so for me, it's more about what's the logic that they've applied to get to that number, and do I have they exaggerated it intentionally, or is it some analysis and critical analysis has gone into coming up with the number? And if it's still wildly wrong, but they've approached it logically, then I'm relaxed. And it actually will give me an insight as to how do they approach other problems? Are they people that exaggerate all the time, or are they critical thinkers that have gone methodically through and said, this is what we think based on these data points our TAM is?
I think that's a really important point, actually, Peter. I quite like the idea that believability and deliverability of a TAM is not as important as the logic and thinking that's gone into it. I think that's really, I like that way, and that would be my suggestion to all the edtech entrepreneurs that are in the call today. Put together a thinking pattern, a strong thinking pattern about how you got there, because every investment analysis scenario, every document has assumed some assumptions underlying it, and if you can outline those assumptions, that allows people to think that there's some legs in this. So I think I would agree with that. I might, before we jump into thinking about investment trends across edtech as a whole, I'm wondering whether or not you might want to share some of the things that you've seen over the journey that you either believed or didn't believe that has gone the opposite way, right? Like, Peter, if I ask you, if you say, hey, you looked at something, I think you've just mentioned that you invested in Go1 recently, right? In their latest round. Yeah. Now, I think that must be like their Series D or something, I would think, maybe Series E even.
It was a D3. So
D3.
Okay.
See, wow, we're getting all these subsets of series rounds as well.
The names are becoming meaningless, aren't they?
Oh, well, what do you mean by becoming? But anyway, I'm now starting to sound like an old man saying, "Get off my grass." Like I won't do that often. So, so maybe can you give us a bit of insight into something that you looked at and you went, "Hey, that doesn't make sense." And you never invested in it and went on to do something. You don't have to give us names of companies, or the other way, something that you believed in it didn't happen in education. Question without notice.
Yeah, so
you get thinking time, Judy.
Yeah.
Peter will give us such erudite response. We will be so blown away with it. May not get to you.
I think I won't name a business, but
Yeah, of course.
I think sometimes what I've learned over time is that things take longer than you think, and industries evolve over time, but that evolution also takes longer. And so, if you see a new opportunity and you think you're at the forefront of a brand new trend, and expect that you're going to make millions of dollars because you're at the forefront of this new trend, expect that you're probably not, and the trend will take longer than you thought, and maybe you won't get a return on that money. So I won't add too much because it's a real example, and it would be unfair to name the company, but I'll have a think about the way to describe the industry while Judy's talking, that without being unfair to the company.
That may be enough insight as well. Judy, did you want to sort of jump in there and say, hey, this is an entire trend that we missed, or we didn't believe in, or we found, or, blah, 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 or along those lines, really?
Yeah, I mean, I generally agree with what Peter said around just kind of things taking longer than you'd expect. I think especially when you work in, a space like education, you're oftentimes working with like big stakeholders. Maybe that's universities, maybe that's K-12 systems, maybe that's the government sometimes. And even in healthcare, where I have some experience as well, maybe you're working with insurance companies, maybe you're working with, Medicaid agencies in the US at least. And so things I think like that often do end up taking longer than you'd expect. Or maybe you're working with like larger enterprises trying to sell large contracts or whatever it may be. And I do think things like that end up over time. I will say though that when things go right, it feels like it just, things really go right. And so like there's kind of a domino effect in either direction, where if things go slow, things can go slow either way. And then when things really work, I think it just kind of dominoes on its self, whether it's like organic virality, referrals, etc. I would also say maybe like a popular prediction that people had might have been like, during COVID, we kind of had like this penetration of online training. Maybe that kind of gets at the trends as well. And that's all going to kind of go away post-COVID. It feels like we're kind of at the point where like, that's probably not going to happen, right? I think at least for our fund, we generally believe that COVID has accelerated a lot of the trends around already like long-term secular trends of online training and education penetration. So it feels like that's not going away much, but it does feel like also there's sort of there's a little bit of kind of people feeling maybe fatigue with Zoom or online stuff, or even just kind of like buying subscriptions and things like that. So we've seen a little bit of that in like direct to consumer companies that we've looked at, where they've seen a little bit of that, down after COVID, but generally feels like in the long term, we're not kind of going anywhere on that front.
I think it's a good segue to move into those key trends that we're seeing. So maybe that question to you as well, Peter, like what are the key trends that you're seeing that you're bullish on, that you want to be investing in? And I'll come back and connect back to this COVID statement in a second as well, Judy, but over to you first, Peter. What are the key trends you're seeing and that you want to invest in?
Yeah, so I really like the workforce space, and Judy and I were talking about this offline. It's one of those spaces where you don't get impacted by regulatory hurdles. So there's there's some spaces where you can have great technology and a really well-run business, and then for whatever reason it's lights out. So we're invested in a business that fell into that category, that was providing technology to tutoring in China, and really well-run business, unbelievable technology, a lot to like about it, but it just got shut down overnight by a regulatory change. Whereas in the workforce development space, governments tend not to get involved too much in workforce development. If anything, it's about supporting it rather than cutting it down. So I like that, and I think that the globe needs more workforce development. We've got a huge skills shortage globally, and we need to come up with more innovative ways of upskilling people. So that's quite attractive for me. Outside of that, I'm really interested in seeing how things like artificial intelligence and AR and VR can be applied to education and in different settings. In the university space, by way of example, if you are studying medicine, you need a body to cut open and see where the organs are. It's really expensive. You've got to have access to the right rooms, the right teachers, and then you've got to have a body. But with AR and VR, you can do that over and over again from any corner of the world. Nobody required. So that's just an example of how AR and VR can be used in a different setting. So I really like that space as well.
We'll come back to that one. Judy, did you have some key trends that you wanted us to think about?
Yeah, that's great. I mean, and again, we kind of generally invest across the entire spectrum, but I guess some areas that we've been watching, maybe kind of picking up on that note that Peter ended on, the kind of AI and AR, VR technologies, definitely seeing those types of technologies being able to kind of offer better solutions. So for example, we're investors in companies like Labster, which, like to Peter's point, they use AR, VR, and simulation technology to create kind of simulations of labs. So instead of going to an actual lab and having to do all the work and all the safety concerns and the costs, et cetera, students, whether it's K-12 or colleges, are able to do everything virtually, or be able to prep before they actually go into a lab, or people to do different kind of scenarios all over again. Or we're also investors in a company called Interplay Learning that uses VR and simulation technology to teach kind of skilled trades, as well to kind of more blue collar workers like HVAC technicians, et cetera, in a hands-on way. I was definitely excited about that trend. Also with kind of AI being able to create more personalized learning to learners, based on where they are. So, some examples of that in our portfolio would be companies like Amira, which is basically like a voice assistant, kind of like an Alexa to teach kids how to read. Unfortunately, in the US, 65% of students are actually not on, reading level. And so this kind of bots or technology is able to give kind of one-on-one personalized tutoring using AI to each of the students at every different type of level. And kind of, those, I think that also kind of goes to workforce as well, where, organizations and managers are really thinking about where skills are changing really rapidly, and the increasing skills gaps there. So being able to identify and understand where people's skills are and employee skills are, and are able to create kind of personalized learning for each of those employees based on where their journeys are going, I think is a key trend that we're pretty excited about as well.
There's a fantastic question in the chat, which I'll come to in a second, but I just wanted to go back to a point you raised before, Judy, and talk a little bit about COVID and I think what it may have done. And I'll ask you both to add on to the back of this, but I've been making the statement that let's not think about the way that online learning and education technology was used during the pandemic as the gold standard for online learning and ed tech. It was an emergency response, and it was by no means fantastic implementation of digital pedagogy, digital assessment, digital engagement, and all of those things that we hope to achieve with a technical solution. So let's use that as a foundation from which to build. But I think that there are some big macro trends that came out of the COVID environment that won't go away. I'd agree with your comment, Peter, around workforce training. I agree it's going to have less regulation, but in fact, I can't imagine workforce training will ever go back to a model of going into a hotel, 5-star hotel, eating, mints and crappy food for 3 days of training on, corporate communications. I can't imagine that will ever happen. I imagine we will stay in some sort of synchronous and asynchronous model going forward at the point of need and so forth, and micro-credentials and things like that. But I think one of the really big macro trends that's going to come out of COVID, and I spend my life in K-12 schools, is every parent in the world is acutely aware of how hard it is to be a teacher today. And because they've had to do it themselves, they've had to homeschool over the last couple of years, which I think that will drive is a much bigger B2C type or direct to learner model around supplementary components into developed markets, Australia, the US, the UK, Europe, where that's been a model in the sort of emerging markets of emerging economies of South America, Africa and Central Asia. So I guess the final piece before we move on from trends is there, for you, Peter, has COVID made it a more interesting place for you as an investor in terms of competition or deals coming your way, or has it made it a more challenging? I don't know.
Oh, without a shadow of a doubt, it's made it more interesting. So you'll probably be familiar with this feeling, but for those of us that are involved in EdTech and have been for some time, it's something that we know and love, but nobody else outside the group is interested. They don't even talk about it. They don't know what it is. You can hardly spell it. But now everybody is interested in EdTech. So it's been a good thing for the market. From an investor's perspective, it does mean that there is more competition for deals. So a lot of the generalist funds are also interested in EdTech now that maybe they would have flown under the radar previously, but that's okay. That keeps everybody on their toes, and it's good for the businesses that are looking to raise capital. So without a shadow of a doubt, it's been a good
I did notice all of the founders that are in this call shed a tear when they heard you complaining having to pay more for the shares that you wanted to give them, or get less shares for the capital you wanted to give them. So at least you acknowledge that that's important, Peter, right? We want venture capitalists and private equity people to not get their fair share. We couldn't expect that. So.
Yeah. No, it's brought forward by 10 years, probably where we would have been. I think we're already on a trend where people were beginning to understand the opportunity in EdTech and see what a big opportunity it could be. But then COVID hit, and now much more people are interested. Much more people are interested in investing in the space, and that will, more investment will drive more businesses starting up and new technologies and better classroom experiences and better outcomes. So
yeah, of course. Judy, same question to you, but I'm also going to ask you to address the question that's in the chat, which I think is a fantastic one, which is, are there specific EdTech sectors or solution types that get traction faster than others? So maybe you can give us the answer to the first one around, has the pandemic helped you in this process, and also maybe try and tie into that question as well, because I think it's a great question.
Yeah, that's great. Yeah, I mean, I'd agree with Peter. It's definitely made my job more interesting. I also think it's been a net positive just because we're also seeing generalists coming into our portfolio on later stage investments, and then on the, there is definitely more competition, but also a lot of cooperation as well, right? So generalists wanting to, bring us into deals for our expertise and that type of stuff as well. I also think the interesting part for me has been all the new entrepreneurs that have started out during COVID. I think to David's point, COVID was a crazy time. It was an emergency response, emergency actions. I think it also unveiled a lot of issues that we already had in our system that became areas for entrepreneurs to tackle. And so, examples, in our portfolio would be a company like Class Technologies, which is actually founded by Michael Chasen, formerly the founder of Blackboard, the large LMS. And so he, during COVID, created a Zoom for learning, for synchronous learning. So in the same way that Zoom really hasn't served schools, didn't really, have all the right learning tools, learning management, things that we would need, he kind of built something on top of Zoom that provides all of those features that you would need, whether it's attendance tracking, analytics, speaking times, being able to put people in ABC order, take attendance, being able to tap a student, manage breakout rooms. And so that's an example of a company. And then getting to kind of the question in the chat that actually scaled very quickly. And I think for a couple of reasons. I think for one, it was built on top of Zoom. So every client that Zoom was serving on the educational side, they could get into. Obviously the demand for that was pretty high during COVID. And then they are also tackling multiple sectors. So K-12 is definitely one, learning, one kind of client profile, but they also do university and then corporate training as well. And to David's point, that's not going back to in person, right? So thinking about, all that money saved for the companies, how do they create more engaging, more efficient online synchronous training for their employees? They've actually gotten a lot of traction there as well. So I'd say on the sectors and solutions that can get traction faster than others, I think it depends. I'd say that in general, if you really had to generalize, like companies are probably going to move faster. Your sales times are going to be probably shorter with a company.
You mean like workforce, if you're selling, if your customers workforce.
Yes, like an employer versus like a K-12 or university. With that said, at least in the US, there are a lot of urgent issues that K-12 schools are fighting against, that where they're moving really quickly on some things that are high priority. So things like, again, like online training during online education during COVID. And then mental health is actually another example where we're investors in a company called Hazel Health, now providing telemedicine and mental health services to kids using schools as the channel. And that's actually gotten, seen very fast traction. So I think when you're building for an urgent problem, a large problem that has no solutions, you're just going to see people move much faster versus, if you were building something where there's already 10 other solutions, now you're just competing with an incumbent or, having to kind of beat people out during RFPs, and that gets a little bit harder.
I think we've got about 10 minutes left, so I'm going to ask you to maybe also make a comment too, Peter, about this. Are there solutions that you think get faster traction? And then I want to sort of jump into some technical components in a minute. So did you want to add anything there to any sectors that you think have faster traction?
I think Judy's pretty well covered. I think I'm on the same page. I think anything in the workforce space and anything where it's technology built on existing technology, so the path to adoption en masse is truncated. And then class.com is the perfect example. People got used to Zoom, but it wasn't purpose built for the classroom. But class.com is, because it's built, it's leveraging what everybody got used to, even though it wasn't built for the classroom. Class.com is. So I think they're great examples.
And also it gives those entrepreneurs an insight to something as well. And that is, there was already a channel. They didn't have to educate the market. They came in and they added value to it, so that helped them with traction as well. Can I add my view around traction? And my only comment, I don't know that there's any one sector that goes faster than others. I will say the closer you get to the core operations of an education institution, whether it's a school, a university, or a TAFE, or a registered training organization, the greater the risk for the customer, which extends the sales cycle. So that's always a harder thing. But the upside is it's sticky. The closer you get to the core operations, the harder it is to displace, which then creates that defensibility thing that Peter talked about before, which is where you then, force people to be paying 10, 12, 20, 30 times revenue, not, 3, 4, 5 times revenue. So it is a double-edged sword. But we've got about 5 to 8 minutes left, and I wanted to jump into a couple of rapid questions for both of you, really around the technical aspects of what you want to see from people. So let's talk a little bit about the term sheet process. Can you give us a bit of an idea of how do you actually operate, Peter? If you've got an organization, you're thinking about them, you're thinking about making an offer, what would that look like? What would the due diligence and the term sheet process look like in a minute?
So the first thing to note is that the whole process is now taking longer. So given the market downturn, particularly at the late stages and the publicly listed market, which has an impact on late stage VC and PE investments, people are nervous, investors are nervous, and so they're taking their time. And so there used to be rumors of Tiger having an initial phone call and sending a term sheet 10 minutes after the first phone call. That's not happening anymore. It's not happening anywhere. And that's a good thing both for the investors and for the companies, because you're going to be in bed with each other, so to speak, for 5 years, 10 years or more. So you want to know that you get on well and that you really understand the business and and like the investor that would be coming onto your cap table. So the whole process is taking slower, and people are getting to know each other. So that's a positive. I think also slowly, it's probably too early to give definitive examples just now, but I think probably the tide is tipping in favor of the investor now. So the terms that are going on to term sheets are probably a little bit more investor friendly than they have been, because people have been so desperate to get cash out the door and invest, that they've been willing to take terms that haven't been as friendly to investors. So I think number one, deals are happening slower, and number two, I think the terms are a bit friendlier. I wouldn't say they're in favour of. I should rephrase that. I don't know that they're in favour of the investor per se. They're just a bit more sensible than perhaps they were 12 months ago, 6 months ago, even.
Same question to you, Judy. Is there something you want to add in there in terms of the process? I've got a question I wanted to add in a second, but did you want to add anything to what Peter said there around process and structure?
No, I think generally agree with Peter. I mean, I would say I feel like things have really normalized because it did get a little bit crazy at the kind of peak of the cycle. And I'd say in terms of, our process, at least, obviously kind of getting to know the team, understanding some of the data that's available, being able to kind of discuss key topics, being able to kind of do reference calls probably closer to kind of that term sheet timeline, having our entire team meet them and just kind of, being able to do our work in the background, whether it's doing our kind of like market expert calls or, our analysis of the data and that type of stuff. Yes, it's a pretty straightforward process for us. And at least for us, our team is our IC, so we can move pretty quickly on the decision-making process as we get to that term sheet stage.
I'm going to stay with you for a moment, Judy. I want to ask you a question, and hopefully you can answer quickly, which is, at what point do you want to see a founder engaging a professional consultant helping in the capital raise?
Yeah, at least in the US, and I don't know what it's like in other markets. And I know actually in markets like India, those are actually really popular. In the US, most raises are actually done by the entrepreneurs. And
in the US?
Yeah, in the US.
Up to what level? Up to what level do you expect to see the entrepreneur in the whole conversation?
At what level you're saying, or what stage?
Yeah, does it stop, or at some point do they get professional advisors?
Yeah, I think when you get to kind of like the more true growth stage, whether it's Series C, D, if you're actually looking to sell to a financial buyer, then that's when definitely people, investment bankers are involved. But generally, we're seeing kind of founder-led processes.
What about you, Peter? Where are you comfortable or uncomfortable with early stage founders bringing in a professional consultant?
I prefer that they don't have a consultant, not because we're looking to squeeze them for better terms, but just it's more that sometimes these guys are slick and they've just got an answer for everything, and it makes it harder to get to the core of the problem. So, I would prefer to be dealing directly with a founder and workshopping an issue. If I don't understand a part of their business, I want to spend 10, 15 minutes with them discussing it and hearing how they explain it and how they approach a problem, rather than hearing a slick response from a consultant. So I get that there's a space for consultants, and entrepreneurs have got a lot on their plate. And if they can get help from an advisor, that makes sense, particularly if it's a sale. If it's a full sale, it's a no-brainer. You've got to get help. But if it's just raising a round, I would prefer to be dealing direct with the founders.
Yeah, so I'll add in the point that you made before, Judy. I think that we're seeing a mix in the market between founders doing it themselves and bringing in professional consultants to help in that process in the Australian market at the moment. But I think most investors who understand the sector fall into Peter's category of wanting to hear directly from the founder. And if you're in the middle, or if you're a founder in this call and thinking about doing a capital raise, I would strongly recommend that you have an professional advisor who hands over to you at some point. By all means, get them into the process to help, craft pitch decks and, run their eye over total addressable markets and, forecasts. Absolutely. But at some point, I think if you're trying to raise sort of $500,000, $1 million, or a couple of $1 million, or in almost every instance, the investors going to hear from you, because they're going to want to hear the warts and all story. And as Peter said, a big part of this process is you're about to get into bed with someone for not a one-night stand, but for a marriage. You're going to be in this relationship for good or bad for a long time. At the absolute fastest, it might be 3 or 4 years. At the absolute outside, it could be 10 or 15 or 20 years. So you want to make sure that you like that person and you want to test that relationship. So I think we've officially come to the end of our piece. So I wanted to say thank you so very much, Judy, for your time, because I know it's now approaching sort of 9:30 or 10 p.m. where you are. So thank you very much. And Peter, again, thank you for giving your contribution today. Thank you.
Pleasure. Thanks for having me.
Yeah, Thank you very much. I'll just reiterate, David, thank you, Peter and Judy, and thank you, David, as well, for joining us today and volunteering your very valuable time. I know you all have action-packed schedules, so we're grateful to have you join us. And Judy, I hope we haven't pushed back your bedtime too much. That was a really amazing conversation. It's a shame to bring that one to an end. So that does bring the end of the stream portion of today's program to an end. Thank you to all joining us from Slido through our live stream. We look forward to hosting you in our next and final discussion on October 18th, exploring partnerships for growth.